Good afternoon, everyone, and welcome to Miller Johnson's Benefits Lunch Break webinar series for the month of April. My name is Brett Leafbrower, and I am an attorney in Miller Johnson's Employee Benefits Practice Group, and I will be taking you through today's presentation. Before we begin, we also have some upcoming webinars throughout the rest of 2023. And these are the dates to be aware of and to save so that you can tune into those presentations. If you have any upcoming topic ideas that you would like us to cover, please let us know about it in the Q&A feature, or there will also be a post-webinar survey where you can let us know. So without further ado, today I will be talking about proposed changes to the Department of Labor's Voluntary Fiduciary Correction Program. So to begin, what is the VFCP? So the VFCP is a program offered by the Department of Labor that's designed to help retirement plans, their fiduciaries, and any service providers avoid civil enforcement and penalties, provided that those plans, fiduciaries, and service providers correct whatever the mistake was originally. So what is the goal of participation in the VFCP? Ultimately, the goal is to obtain relief for specific prohibited transactions, which we'll talk about shortly. And ultimately, the goal is to receive a no action letter from the Department of Labor, which is basically a letter that states that the Department of Labor will not pursue any civil enforcement activity and will not impose any penalties related to the prohibited transaction corrected through the VFCP. And also in certain circumstances, employers may be able to obtain excise tax relief under a prohibited transaction exemption 2002-51. So this relief is relief from penalties that may be imposed by the IRS for a prohibited transaction. So what are prohibited transactions? Prohibited transactions are transactions between a retirement plan and what's referred to as a party in interest under ERISA or a disqualified person under the Internal Revenue Code. So under ERISA, a party in interest is essentially any entity or individual that has a financial interest in or fiduciary relationship to the retirement plan. So clearly this includes fiduciaries. It includes employees of the employer maintaining the plan, owners of the employer maintaining the plan, service providers to the plan, which would include record keepers, trustees, and advisors to the plan. And in general, any individual entity that is related to any of these above persons or entities. So essentially any family members of these categories of individuals. So under the Internal Revenue Code, it's mostly the same types of individuals and entities that are considered disqualified persons. There are some differences between the definition of party in interest and disqualified persons. For example, the code definition has some very technical stock ownership rules. For example, if an owner owns 50% or more of the voting stock of a company, and that company has employees covered by the plan, that individual could be a disqualified person. And for purposes of this presentation, we'll be using the terms interchangeably. So under the prohibited transaction rules, a prohibited transaction is defined as any direct or indirect sale or exchange or leasing of property, the lending of money or extension of credit between a plan and a party in interest, and basically just any exchange of goods, services, money, potentially real estate, basically any assets of a plan and a party in interest. And furthermore, under the code as well, prohibited transactions generally also include a disqualified person's transfer of plan assets for his or her own benefit. And the second bullet point here, a fiduciary's act by which he or she deals with plan assets in his or her own interest This point will be very important for the rest of the presentation when I talk about what some of the most common prohibited transactions are. And third, a fiduciary's receipt of consideration for his or her own account in a transaction that involves plan assets from any party dealing with the plan. And the last few items on the list here are basically the same items that we discussed on the previous slide. So there are currently 19 prohibited transactions that may be corrected under the VFCP. And what I have here is a screenshot of the current VFCP application. And you can see the 19 different types of prohibited transactions that the DOL allows plan sponsors to correct. And for the majority of today's discussion, we'll be focused on the topmost item in this list: delinquent participant contributions and participant loan repayments to pension plans. So as just mentioned, the two most common errors that may be corrected under the VFCP are delinquent employer remittances of participant contributions and delinquent employer remittances of loan repayments. So under the DOL regulations, employers must remit amounts to the plan on the earliest date that they can reasonably be segregated from the employer's general assets. So what does that mean? The DOL has given us an outer limit for this purpose, which requires employers to remit participant contributions and loan repayments to a plan within 15 days of withholding. However, this is only an outer limit. Ultimately, the DOL will look at an employer's pattern of remittance practices to determine how soon that specific employer can remit contributions to the plan. So in my experience, most of the plans that I have dealt with are typically remitting these contributions to the plan within 3 to 7 days. And very few, if any, plans are remitting on a consistent basis the contributions on the 15th day or close to the 15th day. So for all intents and purposes, this 15-day limit is going to be irrelevant for most plans because the limit will be specifically determined by that specific employer's practices. There is also a 7 business day safe harbor rule for small plans. This only applies to plans that have fewer than 100 participants as of the first day of each plan year. And the rule is a safe harbor that provides that the employee contributions will be deemed to be timely if the amounts are deposited to the plan no later than the 7th business day following the date that the contributions are received by the employer. So please note that this is just a safe harbor. A plan could still establish, by its remittance practices, that it's able to contribute contributions to the plan by the 3rd business day, for example. And this could be relevant for determining what the loss date is for calculating or proceeding with the correction. So how does a plan make a correction under the VFCP once a mistake has been made? So the current process is for an applicant, which is typically the plan sponsor, to file an application with the Department of Labor. And the Department of Labor will assign an agent, a live person, to review the application. And typically there's some back and forth between the plan sponsor and the agent to ensure that the correction is done properly. And what needs to go into the VFCP application: the prohibited transaction needs to be identified. Whatever is being included in the application needs to be identified. And the plan sponsor needs to identify how the error occurred and how the employer's procedures are being changed to ensure that the error doesn't happen again in the future. And the applicant needs to explain how the prohibited transaction was corrected. Typically, this would be by providing evidence that the late contributions have been deposited into the plan. And in addition, the lost earnings have been remitted to the plan as well. And lost earnings are essentially interest on the late contributions. And most commonly, lost earnings are calculated using the Department of Labor's VFCP online calculator, which is a relatively simple to use calculator that the DOL makes available on its website to calculate lost earnings. Alternatively, there are some circumstances where an applicant may use actual earnings. And in those cases, typically the calculation of those actual earnings must also be provided to the Department of Labor. And finally, proof of the correction needs to be submitted. So usually these are payroll reports that show the amounts that were withheld from individuals' paychecks, as well as trust reports or bank account statements showing the deposit of the amounts that were withheld, as well as lost earnings, showing the deposit into the trust or into the plan. And this is a good spot to address a question that I received in advance of the presentation. And the question is, do we, as a plan sponsor, need to know the full scope of the problem, for example, with the specific dollar amount, before we can submit a VFCP application, or can we submit follow-up information? And the answer is that with respect to a VFCP application, the application should only be filed after the correction has been made. So only known errors with specific dollar amounts that have already been corrected should be included in that VFCP application. And with that said, if it's later discovered that there have been additional errors or the scope of the original problem is larger than expected, it is possible to correct those errors at a later time and to submit a new VFCP application to address those specific errors. And that's not uncommon for that to happen as well. So the Department of Labor is not the only entity interested in the prohibited transaction. The IRS is interested too. So under the code, a disqualified person who takes part in a prohibited transaction generally must pay a 15% excise tax based on the amount involved in the transaction. And with respect to delinquent contributions and loan repayments, the amount involved is the amount of lost earnings on the employee contributions. And this is a common mistake that I see where individuals use the amount of employee contributions as the amount involved, and that will greatly increase the amount of excise tax that needs or should be paid to the IRS. And so how is this excise tax reported and paid? Plan sponsors use IRS Form 5330 to report the amount of the excise tax to the IRS. And typically a check payable to the United States Treasury is sent with the 5330 to make payment. And as just discussed, since the amount of lost earnings is the amount involved, the amount of excise tax is usually very small in a lot of these filings. And unfortunately, there is no de minimis threshold that the IRS uses. So it is somewhat common to prepare this 5330, which can be a difficult form to prepare, and only have to pay less than $100 in excise tax. And we at Miller Johnson have experience preparing these forms 5330, and we can help employers prepare them and calculate the excise tax. There is a prohibited transaction exemption, 2002-51, which will allow an applicant to pay excise tax to the plan instead of the IRS for all intents and purposes. And the exemption only covers 6 of the prohibited transactions that are identified in the VFCP. Notably, however, it does cover delinquent participant contributions, and loan repayments. So to qualify for relief under this PTE 2002, the participant contributions and loan repayments must be transmitted to the plan not more than 180 calendar days from the date that they would have otherwise been payable to the participant. In my experience, this requirement is typically met, usually when a contribution is remitted to the plan late. It's usually sent within about 2 weeks to a month or 2 months. Usually employers identify their own error and correct it pretty quickly. And also under this exemption, the transaction cannot be part of an agreement designed to benefit a party in interest. And the applicant may only use the relief offered under the exemption once every 3 years for similar types of transactions. In order to obtain the relief under this exemption, the DOL requires the applicant to give written notice to interested persons, which are essentially the participants and beneficiaries under the plan, within 60 calendar days of the date that the VFCP application was filed. And in this notice to interested persons, the applicant needs to inform participants that the applicant is participating in the VFCP and that the applicant intends to obtain excise tax relief under the exemption. The applicant also has to inform participants that they have 30 days to submit comments to the EBSA office that is reviewing the VFCP submission. There are certain circumstances where no notice to interested persons is required. And those are when the amount of excise tax would be no more than $100. And the excise tax is contributed to the plan and allocated to participants. And finally, a proof of payment to the plan and essentially a copy of the calculation of how the excise tax was calculated must be included as part of the VFCP application. Moving on to the proposed changes to the VFCP. The VFCP program was last updated over 15 years ago. The last changes were in 2006, and these new proposed changes are intended to simplify and expand the original VFCP. And by far the biggest proposed or most significant proposed change to the VFCP is that for late transmittal of employee contributions, the revised VFCP includes a self-correction component, which allows applicants to notify the DOL of a correction rather than submit a full VFCP application that will be reviewed by a live DOL agent. The self-corrector will receive an emailed acknowledgement from EBSA and will not receive a no action letter. And finally, the self-corrector must complete a self-correction component retention record checklist, which we'll go into more detail about in a couple slides. So in lieu of the VFCP application, a notice must be filed with EBSA of the correction, and that notice will include the self-corrector's name and email address, the plan name, the plan sponsor's EIN, and the plan's plan number, the principal amount, the amount of lost earnings, and the date paid to the plan, and the lost date, which is defined differently under the SCC as opposed to the VFCP program. So for purposes of the SCC, the lost date is the date of withholding or receipt, whereas under the VFCP application process, the lost date is actually the date that the plan lost use of the principal amount. So for example, under the VFCP application process, if an employer typically remits these contributions to the plan within 3 days, that third day will actually be the lost date as opposed to, day one, which is the date of withholding or receipt. The reason the SCC presumably has made this change to the lost date is it will slightly, by using an earlier loss date, this will slightly increase the amount of lost earnings that are remitted to the plan. And if more lost earnings are remitted to the plan, the participants are receiving more money, and that is in the best interest of the participants. And lastly, the notice must contain the number of participants affected by the correction. And I find this point to be interesting because it's not apparent yet whether the Department of Labor will be using these notices to identify certain plans that it wants to verify that the correction has been made. For example, if it will use this information to identify large corrections and then, pursue verification of those larger corrections. We'll have to wait and see. So the self-correction component is not available if the late deposits of participant contributions or loan repayments are made more than 180 calendar days after the date of withholding or receipt. So you may recall seeing this 180 days earlier in our discussion because this is the same 180-day requirement to qualify for excise tax relief under PTE 2002-51. So the SCC is also not available if the amount of lost earnings exceeds $1,000, excluding the amount of excise tax. And finally, the SCC is not available if the plan or sponsor is under DOL investigation. So a self-corrector must complete this retention record checklist, which currently is included in Appendix F of the DOL's proposed rules. And the corrector must prepare or collect all of the listed documents, keep a copy of the completed checklist and the required documentation in the applicant's records in order to obtain the relief under the SCC. So the information required by this to be, collected by this retention record checklist is very similar to the documentation that is required to be submitted with a full VFCP application. And here is the list of questions and required information that is listed in this checklist. So as the applicant, did you attach a brief statement explaining why the participant contributions were retained instead of timely being forwarded? Basically, this question is asking, why did the breach occur? And the second question, did you attach proof of payments showing the date the plan received the corrective payments? And did you attach a copy of the DOL's VFCP online calculator page? Notably, with respect to this third question, in order to retain relief under the SCC, the DOL's VFCP online calculator must be used. So you are not allowed to use actual earnings if you are proceeding under the SCC. You must also answer why or how will the employer prevent future delinquencies from occurring. And you also must keep or attach the notice acknowledgement that you receive when you submit the notice of your correction. And the final 2 points, did a plan official sign a penalty of perjury statement? And did a plan official authorize a preparer to submit the SCC notice? These are important because it means that between the notice being filed with the Department of Labor and a plan official being required to sign a statement or authorization of a preparer, it means that corrections under the SCC are not going to be anonymous. There were other less significant proposed changes to the VFCP. For example, for a plan's impermissible purchase of an asset from a party in interest, the revised VFCP would now allow a VFCP applicant to take credit for the plan's earnings from owning the asset purchased from the party in interest. This prevents the plan from basically recognizing a windfall from being able to keep the earnings from owning the asset and also receiving a corrective payment. Second, a plan service provider may obtain relief under the revised VFCP for a bulk application in situations involving breaches across multiple plans, even if one or more of the plans is under investigation. Presumably, this exception recognizes the possibility that service providers may not necessarily know about their clients being under investigation. So one client of a service provider being under investigation will not prevent relief for other plan sponsors that are included in the application. In addition, the definition of under investigation has been clarified so that an applicant will be considered under investigation if the applicant has received a written or oral notice of an investigation, review, or examination. So corresponding changes have also been made to PTE 2002-51, basically to go hand in hand with this self-correction process. So the DOL is proposing to revise the exemption so that no notice to interested persons would be required in connection with the self-corrected late contributions that meet the conditions of the SCC under the VFCP. So the requirement that makes excise tax relief unavailable to applicants who have utilized the VFCP more than once in the previous 3 years would be eliminated. So essentially, anytime a correction is made under SCC that meets all of the requirements, there is also excise tax relief, even if the excise tax relief is sought more often than once every 3 years. The exemption provides that the excise tax must be calculated and contributed to the plan as additional earnings. So again, under the revised exemption, the amounts can be paid to the plan as opposed to paid to the United States Treasury. So when can plan sponsors expect to use the self-correction component? Potentially soon, because the comment period on the proposed changes to the VFCP just recently closed. So the DOL originally stated that interested persons must submit comments on the VFCP revisions and proposed amendments to the exemption by January 20th, 2023. However, the DOL later announced that it would be reopening and did reopen the public comment period until April 17th, 2023. And the comment period was reopened to allow commenters to address any issues raised by specific references to the VFCP in connection with corrected loans to participants, which were included in the Secure Act 2.0 provisions of the Consolidated Appropriations Act. So ultimately, the DOL wanted to just receive more comments on how the Secure Act 2.0 could impact the VFCP. So with all of that said, the self-correction component under the revised VFCP is not available yet, and we'll have to stay tuned to future DOL communications and ultimately final regulations to learn when the new SCC will be available. And with that, I am not seeing any questions on today's presentation. So we will wrap it up here. And please, everyone, if you have the opportunity, please join us for next month's webinar, which will be taking place on May 17th. And thank you for your time.